So I'll just give a quick introduction to Fibe. I think it's interesting when we all build up our companies. It's one of the few ventures that the founders changed the name uh, after almost 8 years of existence. Usually only founders are close to brand names, and we had quite a cute name, EarlySalary, earlier. It understood what we do as a category, but we realized that we became the category. Like people started saying that we have an early salary product like them. Right? So we said now it's time to change. We are not about a singular product. We're about many things that we do for a young customer. And we really pivoted to say, can we build up a larger than life lending ecosystem? We are backed by TPG, Northwest, Chirate, and Aetros as 4 large institutional investors. We also have a strategic, which is Piramal on the place. We also have really built an asset heavy model that we like to lend on our own balance sheet or do co-lending so that we take the risk and manage the customer over time. Over the last few years, we are proud about a few elements. The first element is we almost have nil attrition, where people really like working in our company. The second is we have the highest retention rate and repeat rate in financial services ever achieved. We are at 88% on every cohort for the last 36 months. It's never been seen, such repeats have never been seen anywhere in the world. We are considered one of the best fintech startups in G20. And we today are doing more than $100 million of disbursement a month, right? So really put up the speed, velocity, and really built up a good ecosystem as we go along. Just as a few highlights about what's happening in the industry, right? Financial services is very simple. Lending is a grassroots product. You're not really curing cancer or solving a very difficult problem. It's the oldest known business in the world after agriculture. Interestingly, 66% of India is under-penetrated when it comes to lending. 18 crore people have never got access to any credit, and these are salaried people in more consideration, right? There are close to 9.7 crore people who have access to some qualified, identified salary in India, out of which 7.2 have never been able to get access to any credit. And that's what really Fibe is about, getting access to these consumers when they come. And we are really chasing a singular goalpost. We are changing a $2 billion outcome in the next 24 months. Now, when companies create very singular focus, it's a little easier for them to build out larger companies. Today, we have done close to 16,000 crores of disbursement on the platform. We have a 20 million active app user base. This has resulted in 2 million people who have used the product and use it almost every month. And also close to 6 million loans have been delivered on the platform. So if you look at, there is a clear leadership coming across in the financial services space. In digitally delivered loans above 10,000 rupees, Fibe has a 20% market share. Remember, there's 700 players in digital lending, and even banks compete in the same space. We really believe in the best-in-class customer retention and customer management. We really believe that customers have to be managed using an AI platform so that they have a seamless experience and everyone gets a seamless experience. There's no difference between a customer coming at 2 a.m. or a physical customer met in a hospital. We have proved that we can manage risk, yet being a digital player and do a good job of doing the entire piece. And of course, we have a strong asset-light model allowing us to do business in a better manner, which means we are better levered. We can build out a financial model, a more efficient ROE, ROA model. I think the first part is always identifying the area that you want to cater to. And as many of you are enthusiastic about financial services, it's a clutter, right? There are hundreds of banks, thousands of NBFCs, lots of digital innovators, but how do you find a white space which is large enough for you to cater? We found a white space which said that loans typically, let's say between 20 to 100,000 rupees, there are not too many lenders in the market who can give a rational price. Most of the time, people either charge too much or try to push too much of money to you. And we found this large white space that we said we can cater to. The white space, interestingly, has 70 million households to cater, which means there's enough target audience available in your base. And we said we will only attract that base. And we have consistently got the same customer that we talk about in the long run we want to build. We didn't go from saying, I'm doing one business, but I'll do a different business as I became larger. We said we are doing this business, we're going to build a larger company behind that core business. We attract an average 28-year-old customer, which means he's 10 years younger than a private bank. We are able to give this most of these people, we are giving, let's say, 1 month of their annual wage as a 6-month product. These customers, as we go from metro to non-metro and to next level cities, we grow in our geography. So one of the clear principles was we cater to a customer segment, but we'll go geography by geography to become large. Over the last 1 year, we have really added mass India. We are now in 264 cities, and the app is now able to cater to, let's say, 20 lakh new customers a month. That's the amount of demand it's generating on the entire platform. The second pillar of any building a large company is how do you have a large acquisition engine, and how do you build distribution moat while you do acquisition engine? Most of you will understand digital marketing and say, listen, I can attract a customer online. I'll not have to worry to build distribution. But every business, if you only do that, then the CAC will start getting impacted very largely. What we have done is we have built very strong partnership tracks. One track is with, let's say, super apps. Anyone who has a large digital footprint, can we help him monetize by giving lending as a product line? We today power 5 of the 9 super apps in the country. So Paytm, Google Pay, etc. become examples there. We power 3 of the payment banks because payment banks can't do lending, that becomes a large component for them. We power 3 mainline banks. When their customer needs less than 100,000 rupee loan, we lend. We of course power everyone in the financial distribution side, from Paisa Bazaar to India Lends to Bajaj, etc. On the other hand, we also build in newer customer channels where we attract customers that are similar to us, but then we can cross-sell something else later to him. So we power almost all the digital skilling platforms. We power all the health insurance companies, and we power most of the hospitals in the country to give zero cost EMI. So all put together, we have built strong distribution. In most of the case, we have an integrated play in our distribution, which means we cannot be replaced. We run our network servers there, and we also have what we call as jar files, which pre-approve customers using their proprietary data of the distributor, which means now you're irreplaceable in his ecosystem. For many of the players, either we are pure exclusive or we have first rights on customer, which gives us very large distribution layer and really built-in CAC control measures. The second part is really how do you have the best-in-class experience on the platform? And today, experience can only be demonstrated by results. I mentioned about the highest repeat rate in the company coming in, and we have demonstrated the highest repeat rate in financial services in Asia. So we have a few companies maybe in the European markets who did something better, but we have really demonstrated in world-class product coming out of India. The second part is we have the highest rated lending app, we have the highest NPS, and we have the highest attachment rate. That attachment rate is very important in financial services because you will have to start selling something else overall, right? You can't be known for selling one product. And as you go larger, can you generate second line of revenue and income? For example, we introduced let's say an insurance attachment product. Today, we're able to generate 2 crores of monthly revenue from just adding insurance as a product line. Next would be cards. Next would be, let's say, a savings product, etc. And each of them can generate large revenue lines for you coming in. Right. The third part is always about demonstrating, can you outperform the benchmark industry, and can you outperform someone else in the market? The bottom graph really shows that we are able to outperform the credit bureau by almost 6% on every single customer segment, which means that if a traditional player was to use, let's say, Sibyl or Equifax and do decisioning, we will outperform them by 6%. And remember, in this business, the difference is always about 1 or 2% in profitability, right? When you're 6% on risk lower, which means now you have 6% more pure revenue margins coming in, right? And it adds up to your entire principal. Today, we generate close to 5% ROA and we generate almost 30% ROE. Now, this is a sign that the company is extremely revenue generating, very high in profitability. And these are the graphs which show an early indicators that can you take risk on the same customer and can you manage him better? The above answer really comes and says, are you really using AI and automation in your entire company? We are 92% fully automated. We are just 700 people. We do more loan processing than most of the private banks in the country today. So usually to process our loan demand, you should have a 5,000 member physical team. We just have a 14 member team who does processing of these loan applications, which means most of my team are busy building up something new or building a new tech capability so we can introduce newer products. And we try to introduce a new line business every 18 months. The last part about any lending entity is really about leverage and how do you build a supply side when you get demand side also. Today, we have been able to build three large supply side solutions. One is working with larger than life banks and NBFCs on direct debt. We own a triple B stable rate in NBFC, and that itself has been able to raise close to 6,000 crores of direct debt. The second is co-lending. This allows us an off-balance sheet treatment where we can do synthetic credit to really manage larger debt pipelines. Here, what's interesting is we are able to do at scale business. Let's say we do 400 crores of monthly co-lending. The synthetic credit also allows us to do larger businesses underneath making. And some of our partners in, let's say, co-lending are okay to give us between 500 to 1,000 crores of lines, which means as I grow from doing a 2,500 crore AUM to reaching 15,000 crore AUM, there is enough supply side available on demand any given time. And the last is, can you also raise money from non-banks and non-financial institutions by releasing NCDs, bonds, etc., from the public market? And can you borrow from HNIs and other institutions also? In fact, as on today morning, we have a listed bond in the market. So you can see our name in the BSE index every day. And really, I'm just summarizing as you build a fintech, what is important, or when you build any company, what's important. One, of course, you have to be very customer centric and make sure that you retain the customer over time. You can't monetize one shot. You have to monetize for a very long window. Today, let's say the LTV on a customer is almost 15 times, and we generate close to 30,000 rupees as an LTV for a customer. We have a very strong lending practice at the back, which means that we can acquire more customers and have supply side always sorted. And the other side is always we have an omni-channel acquisition technique, many channels running parallelly, and we can create new channels to go and source customers. And of course, I mentioned about hyper automation using best-in-class technology so that you can service a company to build a much larger organization. So I'm going to stop here. This gives a summary of what we do. Let's now take in many areas of fintech. I'm sure there are opportunities and segments that you look at. Fintech today is evolving. One, the regulator himself is the biggest innovator, and MPCI along with him. And you do a catch-up game every 1-2 years. They come up with a game-changing capability, or they change the guidelines and the regulations. We like the asset-heavy approach, and we have always said that we will not do a product where we don't own the license behind it, right? Or we don't work with a licensed entity. The second is we like to play the regulations. When digital lending became more complex, the founders here went and set up the SRO in making for the industry. We said we lobby to get our way of running correctly done so that all our participants in the industry can get benefited. And we can weed out the, let's say, the unethical lenders. We successfully managed to remove 600 Chinese competition from the Indian market, right, where they were doing, and that also gave the headway from the regulators saying that we are doing a very strong business model as you go behind. Right. So let's first talk about fintech. How do you manage regulations in any of your businesses? Do you find that becomes very interesting? Open to questions here.
Yeah, Akshay, one question I have is that there are some cases where the regulator itself does not seem very clear. Like there were discussion papers or regulations under framing, right? So there is a lot of gray areas, so to say, which take a few years to settle down before something happens. Now, problem with a company like us, as you said, we also want to play the regulations and always be compliant, is that the competition which plays more aggressively against the regulation tries to beat us in this, in this gray zone area where we want to stay away from it, and they kind of, take advantage of it. So any specific strategy you can suggest of, how to deal with this?
So one lesson I learned, right? If you're in the gray and if someone else is trying to outbeat you, they're using the gray as a wide space. Usually it backfires, right? And and remember, when you build up scale and regulator says no, I don't like it, right? His definition of does not like it means shut it down right now, or I'll shut you down tomorrow morning, right? We've seen companies completely disappear and collapse. We've seen many of our competition used to generate disproportionate profits because of doing those practices. Overnight, didn't know how to run a company again, and they again shut shop. Right. Usually, in let's say in regulated businesses, there are more people who shut down or face more penalty because of regulation than actually they can make revenue on. Right. The second part is getting flair or clear clarity when you meet the people who are opinion makers who are or helping policy drafting, right? You can't do this alone. You need to have access to people drafting the policy, and you have to have remember, you will get your audience. You can't go ill prepared when you get audience. The amount of things that we are prepared to show the right way of lending, showcase impact, right? And from the junior most person to the senior most person, we always had the same consistent pitch. We had the same results to showcase. Of course, the detailing went up as you went up the pyramid, right? If you remember the elevator pitches in the venture world, right, you could get from 1 minute to 2 days to pitch, right? It depends how much is the time being given and what you want to showcase, right? But the regulator started seeing us with far more respect, right? When he saw what we said we exactly do, right? We always came and told him, what don't you like, right? At least can we remove them from some of our business and showcase the results, right? And when we showcase results, see, this is impacting positive growth in business, he comes back and tells you what to do also. And the second part is, if you think something is in the gray, like we created FACE, which is the SRO and making for the lending industry, it actually put pathways to say what is the right way of running, what is the ethical lender, this is what an ethical lender, this is the code of conduct. The regulator, in fact, then came and said, okay, I like it so much, everyone should follow it, even if you're not a member of FACE, but this is the one to follow. Right? Suddenly we went from having 2 members to now having 47 members. Right? So the SRO itself became the industry automatically getting accepted from it. And the 2 nudges that we found could be useful in your business also.
Fair enough. So we just to add here for understanding of everyone. So we kind of stayed away from gaming in stock markets, right? We are a stock market application. Lot of feature requests coming in for create a game where we can do paper trading and all. SEBI is very clear they don't like it. Lot of our competitors gained huge number of users in a span of 1 to 2 years, and around a couple of months back, everyone got a notice shutting down their business. So
I'll give you an example. Let's say the PPI guidelines which came out. The RBI was always telling I don't like it. We were also experimenting on the side a little bit. But let's say 3 of our competition who had actually raised 4 times more money than us. Right. In fact, one of them had raised almost $80 million to do that business, had no business model next day morning. Right. And he's not recovered. And there is no way he's going to recover again. He's sitting with capital, but doesn't know what to do. Right? The regulator can change the entire business model in a very strong manner. Right. So you need to really understand how they impact your business. The other part is, we also said that we like it asset heavy, right? Which means as you keep becoming bigger in size, you are more privy to what the regulator wants. He also comes and starts spending time. So now we wait for October to happen because now we know For 5 weeks, the regulator was sitting in my office with a 5-member team looking at every single thing and telling me what's going wrong. So I have the biggest auditor. He comes and spends 5 weeks in my office.
Yeah. Hi, Akshay. Vikram here. So I'm from FEMONC. We are an RBI registered MBA. We are an MBFC too. I have a question on cooling period. So on a cooling period, generally for a product and a service, in product, let's say, there's a 3-day cooling, I think minimum 3-day of cooling period is there. So in a product, if someone wants to return it back, or in a service, you don't like the service and return it back, how do you deal this cooling period scenario?
So if you look at the key fact document, now needs to carry the details to full perfection, right? In fact, this guideline note was actually written by us personally on this point, that we should introduce a feature like this, just like it happens in insurance, where you have 15-day free look period. Today, I'll give an indicator. This year, from April to now, we have done close to 1.1 million or 1.4 million loans. We had 4 requests for cancellation. That's it. Right? People who invoked the free look were just 4 people.
Yeah,
right? It's
no,
not
even for us, yeah, even we had 0 invoking of that. But I wanted, a service which we give. See, until we get the money back, I won't be able to cancel the loan. But what happens in service, if someone doesn't like the service on day 1 or day 2, then the whole lot of other problems start in.
Yeah. So in case this happens a little bit in BNPL business, whenever you are doing product or a services purchase, you'll have this issue come up, right? Typically, let's say in merchant settlement models, most of our merchant settlement has a pro rata cancellation clauses. We also have delayed settlement where we see cancellation clause, where we have refund and cancellation issues. And of course, pure settlement, which means that if he did 100 cases, 1 got cancelled, I will settle for 99. In case he does 100 a day, and after 20 days also settle from that 20th day, I'll deduct the 1 and then settle to him.
Thanks, Akshay.
Akshay, our next question would be, how do you control NPAs, and what is an ideal level of NPA?
So every business is different, right? In a home loan business, a 1% NPA is large. In a two-wheeler business, a 6%, 4.5% is considered high. In a unsecured business, the range could be from 3.5 to 15.5, depending on what your name is. But typically, let's say cost of IRR charged to the customer minus the cost of your own debt, what is left, typically 20% of that more than that should not go towards NPA provisioning, right? So that's the gap that you should try to play on. Of course, some businesses have a little bit higher leeway because they may have a larger spread. But these rules are typically followed in the financial services industry. The other way to look at it is, what is the right benchmark for that industry versus others? For example, if your NPA is too high, you will not be able to explain this to forward lenders and your rating will change. Many of our, let's say, competition actually borrowed 200 basis points higher because their NPA is 3% higher. So they have a 3% hit on NPA, plus they have a 2% hit on borrowing cost. And that becomes a large amount of difference in profitability. So they may not, even when NPA is large and they've charged higher margins, but 5% is too much on a margin business to make, right?
Thank you, Akshay. And I have next question. Do you do co-lending or FLDG? How can one scale with FLDG?
So we do all 3. We do directly on our own balance sheet. We have an NBFC. We do 80-20 co-lending with almost 10 players. And we now have FLDG with another 6 players. So we do all 3 formats. Typically, we use these mechanisms for generating a larger efficiency. See, even if you're a well-run company, 3.5 to 4 times lever will be very difficult to demonstrate. Right? There will be too much uncomfort coming in from your lenders. Co-lending allows you straight away 5.5 times, and FLDG allows you almost 20 times. So typically, when you do a combination of on-book, off-book, and co-lending, you can almost show a 7x lever without the let's say the rating agency or the direct lenders panicking, right? It also has one positive impact in our business, that we don't have a negative ALM in our business, right? The maturity is 6 months when we borrow for 3 years. So it just allows the extra flexibility and comfort to lenders coming in.
I'm a founder of Fundu. So in Fundu, what we do, we basically work with MSMEs on a short-term credits. So we normally fulfill their credit gaps on invoice remittances. The major challenge which we are facing right now as a startup, now obviously the business proposition is there, which is very huge on MSME side. But on the lender side, it is like really tough to come up with a lender to make them understand how this model works. And on the capital side, because end of the day, every fintech who is coming up with a lending model, they look for the book size. Now, you build that type of book size, you scale on that type of book size, you get at that particular milestone, then we will come in. So now, for us, the major challenge is to get an NBFC who is like on a stronger side on capital, and how to deal with them, like how to get yes, you have that type of experience where you raise capital. The raising fund and investment is another part, but yes, raising a capital is another challenge for us.
So I think I think if you have multiple teams or two co-founders, one should be on the supply side, one should be on the demand side. Let me be very clear. In our case, also Ashish does the supply side, I do the demand side, right? It's needed because the two schools are very different, right? Lenders to you are going to be far more conservative, right? Founders by design are trying to always sell too many things, and you send the wrong signal, right? You have to either learn how to show very conservative way of talking and representing when you talk to lenders. When you talk on VCs, you have to be in a very growth mindset, right? That's the first part. The second part is it is a chicken and egg story, right? Unless you have large suppliers available, you can't go and do business. But remember, the large suppliers come much later in life. It is the smaller suppliers, and you'll have to have a large number of them. In the beginning, we were okay to take 5 crores of debt from 20 players, right? Now we push to get 50 crores from one player at a time, right? And some of our lenders, and we always look at a lender who can start maybe smaller, but has a path of doing 200-300 crores, right? So you have to do the balancing act, right? The other part is that you can always give a higher FLDG to start with, or let's say your coupon or your risk share can be larger, because remember, he is just giving you capital for lever perspective. If he loses a rupee on it, he's never going to fund you again, right? So it's okay to give higher FLDGs because you know your actual risk model and you will get more money available later.
Yes, so that was another challenge which normally, because again, we know how RBI came up with the LSP models and all. And same way, we also felt that particular heat on ourselves itself. And same way when we started doing, because we started disbursement on after getting clarification from the RBI on this particular year of month, that is like March or April. But yes, on the FLDG side, yes, there was a norms from the RBI will take like 5% is the FLDG model, which would normally works. But none of the NBFCs are keen to do 5%. So
Yeah,
they look
okay.
for
they look
for more larger side.
It's okay to give larger because technically, as I explained to you, if he loses a rupee, he's never going to work with you again. Understand that mindset. FLDG does not mean he's taking any risk. He needs to get, if he has to earn 13%, he has to earn 13%. If it's going to be 15, he has to earn 15. FLDG has no value. It is only for your lever perspective. Yeah.
Yeah. But that is the reason why we are raising funds.
No, you're not raising funds for that. You're not raising money for FLDGs. Don't be under that consideration.
But how we will raise that particular capital? So again, that is again
you have to consider raising money as if you're a traditional company, right? At early stage, 3x lever is maximum. So you're raising equity considering 3x lever. because you had synthetic credit available, you can demonstrate 6x lever. But you don't go and raise for 3x or 6x. You go and raise for 3x.
No, obviously.
Right? Because you never know what will happen in the market. Some fluctuation will take place.
Yes, that had happened because my first NBFC was Kudos Finance.
So he can disappear also overnight.
Obviously, that took a toll for us also on the scale also and on the whole business side also.
Absolutely.
Hi Akshay, great presentation. Love the your product first approach and NPS first approach. So one slide that I noticed here was that you have moved from off-book lending to more on-book lending, right? The graph showed that you're now focusing more on on-book, right? And you said that you're focused on asset heavy. So why is that the case? Why did you take this decision as a company?
No, it wasn't the situation, Neeraj. It was clearly to do with fundraising. We had a net worth of 170 crores and a 1400 crore AUM. Then we went and added 880 crores of equity. So net worth went to 1,000 crores. That is why the level came down. Remember, it'll take you at least a few years to go and deploy the capital that you raise, another few years to go and build a leverage on that capital. So that slide was really about showing that we can do 7.5 times lever, right? If push comes to shove, right? But ideally, anything above 4 is very risky. People will start questioning. Anything above 4.5, they will start questioning, are you AAA rated or not?
I just wanted to ask a little bit about the sort of B2B versus or B2B2C versus direct to consumer models. And I know you're running both, but is that how you started? And what was the thought process as you began to do both?
Okay. So we started as a B2C lender, right? And we wanted to first demonstrate a few elements, right? The first one, fast speed to market and fast scale. B2B2C can be a little bit slower, right? And also you don't enter B2B2C models unless it's already an existing value proposition where you know the end game. Right? Most of the time in B2B2C, you enter into product lines to acquire a customer, but cross-sell something else. At least in financial services, it's like the Bajaj model. You acquire for CD and पीछे आपको personal loan बेचना पड़ता है because you don't make money on the CD, right? Even our B2B2C is that only. But now we are creating some more B2B2C where we believe in distribution modes coming in, right? So an example is we are working with a bank. When the bank is sourcing a CASA, we attach ourselves to improve the CASA efficiency by giving up a loan there. And we at the back, we introduce co-lending. So customer is shared between the bank and us. So his compliance doesn't say I lost the customer, right? The risk still belongs to me. But now my sales team is not deploying for customer sourcing because there is no CAC on it. Even if repeats are lower, I can still have enough incomes coming in to justify. And money deploy is always 80-20 from day one, which means the cross-sell, I can deploy larger money again. And remember, the bank doesn't take the risk. So it's considered 100% my debt only.
Makes sense. So is today between B2B2C and direct to consumer, what's that split in terms of customers coming through? If you could share.
So we have built the B2B2C the last 18 months. In new customer sourcing, almost 30% is B2B2C. But as an AUM game, it's only 5%, right? Because it takes time to build an AUM behind it. Yeah, Ashok.
Hi, good evening, Akshay. Sir, I have a quick question. What is the amount you spend for every app download? That is one question. What is the average cost of that you spend for every active lender? I'm sorry, lendee.
Lendee. So we don't measure any more cost of download, right? Because we may not need a download. We originate on many platforms. We measure on CAC, cost of first loan dispersal.
Correct.
Our CAC has actually come down by 10% over the last 18 months. Our CAC today is trending at $20 per customer, right? And it takes us around 7 months to break even on the customer.
Got it.
Hey Akshay, I'm Ved here from Stolo. We're an options trading platform. So on a general note, I just wanted to understand, are there any certain marketing milestones or pivots or learnings across the brand's journey? Also, you did touch upon it in terms of why you sort of rebranded as well from EarlySalary, considering it was more of became a term with the category versus the brand. So are there any learnings or such milestones that you can also share in the fintech domain as a whole?
Yeah, I think the first is brands are close to founders and marketing managers only. The customer doesn't care on the brand name, right? He only cares what service he gets and does he get it consistently or not. The second part is investing in the right team is most important, not in spending money behind the marketing engine. And many people get influenced by saying, listen, I want to come in the India-Pakistan match and show my brand. Right? There are very few marketing guys who come and say, I won't spend that money. Right? So get the right team and they will really help you out in really building it out. Right? The third part is many of the businesses today, performance marketing can really take in the next mile number. Right. I'll give an example. We may be spending, let's say, 5 to 6 crores a month in performance marketing today. Right. But they've been able to transition to say we will not do a single dollar in brand, but we will still do our, let's say, 50 million brand impressions because of performance. So the brand is very well known. It is very well seen by people. It comes everywhere. But every single rupee is back calculated to figure out what is the net CAC and can I be in this $20 CAC when I build the business model out, right? The second part is very strong marketing automation engines built in. So you can eliminate the physicality in the company. Most fintechs are really a glorified call centers. They have an acquisition engine and someone who calls up and sells at the back, right? Or supports and does somewhat of nurturing. We don't have a call center. We don't believe in a call center and we don't call up a customer, right? We are generating, let's say, 17% of all lending demand in the country. We have never spoken to a customer till date, right? So customer can be serviced without human intervention, without calling. On the other hand, the nurturing system has to be really evolved. We have a 197 practice cataloged nurturing system, which means that you'll be nudged 197 times over a 6-month window, but you'll never realize you got nudged. It's not going to be evasive. It'll come on time, and yet you'll end up borrowing from us.
Thanks for that, Akshay. Just to follow up on that, since you spoke on the automation bit, right? So, considering the business is at scale at the moment, right? So are you looking at using, because data would be the key here, right? Because if you're able to chart out 197 touch points in a 6-month life cycle, this is more of just to understand the business and everything in terms of, are you looking at in-house tools to sort of build that database and sort of keep putting it out, or are you using a mixture of a tool set to sort of drive this automation? And of course, there will be a bit of experimenting, but on the whole, how is the structure?
I think we were a little older in making. When we started off, there was not much available. But let's say we are testing grounds for any new fintech-led tool in the market. We were Perfios's first client. We are AA's first clients. Anyone new in the market, Hyperverge's first client, ID5's first client. So you name the company, we are testing grounds for any fintech innovation, right? And we actually put up open repositories, come and test. If we'll pass it, then go and sell it to someone, right? So that's the first part. The second part is this is a tech company at heart, right? There are, apart from the tech team, there are 54-member machine learning data scientists, right? They are actually, their job is to build the automation and build the repository of data. But not a single team is building any of the visualization systems or the tools. The tools have been purchased from someone else. We need our scorecards. We actually run 17 scorecards, from propensity to collections to disbursement to retention to repeat to behavioral model scorecards, right? And there's 17 parallel scorecards running for each customer. Each scorecard maintenance has to be redone every 3-4 months, right? So that itself takes up most of our energies. But I would say, like, from every automation platform to every integrated system, we'll go and use the third party. There's no point building and maintaining that. What you spend a fair amount of time is building your data lake, because you need your data to get created. You need your proprietary answers to come in to take decisioning science. I'll give you 2 or 3 that we are now spending time on. We felt that PI data will start reducing. We're the first ones to lobby to say, stop mobile phone, alternate data, stop reading contacts, etc. Today, we in fact stopped it 3 years back, and others are now figuring out, okay, regulators didn't like it, right? But now we're doing something very unique. We are now spending time in sound and visual recognition systems, which allows my collections practices to become more efficient. We no more need to call up a customer. The bot calls, the bot decides कि ये pay करेगा नहीं करेगा. So I can reduce, let's say if I'm collecting from 10 lakh active borrowers, right? I'll need at least a 5,000 member call center. I do that practice with 50 people, right? So I'm able to reduce it by 20x. And there is an NLP bot which runs, which says sentiment. It gives all the answers to run business at scale.
Hi, Akshay. So I run an insurtech platform called OneAssure. We basically are infrastructure layer for insurance, health insurance, a plug and play solution for anyone who wants to launch health. We are licensed ourselves. So basically, if you don't have a license, then we basically allow you. No, we're a direct broker. So we got a broking license done. My question was more got to do with, you mentioned in your journey that your origination happens at multiple places, right? Because I am guilty of at one, so I've worked for a lot of startups. So I've seen the digital marketing is addictive, but at the same time, the returns are ridiculously because it's only going to get expensive. It doesn't get cheaper, in my opinion, over a period of time, unless you've invested enough in organic. And you then started doing partnerships which originated customers on some other platform for you, which can be employer, bank, or whatsoever. And what it took for you to get to the first few partnerships, right? 1 to 5. Those are the most critical ones. And you could have partnered with multiple players, right? And why did you go to an employer or a bank, or what made you decide on that, right? Effectively.
I'll take an example from the business that you're in. We also power all the direct health insurers directly.
Yeah, we basically, our partners do end up using, right? I guess Niva Bupa is one popular one which you do.
One of the parts is you have to first go to a partner who is a little bit more apt. He's more apt to do the heavy lifting work that you need him to do.
Okay.
The minute you have a successful result, how do you replicate it fast? We went from showcase, and remember in our business, you have to show a cycle, right? If the loan, you have to show one full cycle. The cycle is 9 months. So day we completed 9 months, right? On Niva Bupa, we went from 1 insurer to 9 insurers in 6 months.
Understood.
Right? We said we had to show a result. We showed 35% penetration in new business. Right? It was such a large use case that we could go to any insurer and say, listen, you can't live without us, plug us in.
Understood.
Right?
But when did you decide to do that? That was the first thing, right? Did you immediately, you mentioned you were a B2C player, right? At some point in time, you took
a lot of
decision.
research work takes place. For example, we are spending time to build out a new category in a school fee finance. Right. Earlier, we couldn't afford consultants, but this was the first project we hired Bain to do research to tell us what else to do. We wanted a similar repeat behavior, right? And we needed 30 repeats per customer to actually make a 30,000 rupees, right?
Yep.
He actually came back and we never thought school fees is a similar area. A parent has 2 children, nursery to class 12 is 15. 15 into 2 is 30 repeats pre-bunt in. That means it suits to your product line. It was an open adjacency, but we never saw it. Right. So you have to keep finding such partnerships. And again, the example, and unless you find these examples, you'll miss the answer. Right. And many times you come and say no to a business. For example, because let's say I came from retail background, we said, let's go and acquire people faster. Either you can go online and you'll find them on Google, or you'll find them in a mall. Let's go and tie up with the largest retailer. Right? We shut down the retailer practice within 5 months of running it and said it also inherently gets the largest amounts of frauds. Right? We are not equipped to handle physical frauds. We are equipped to handle digital frauds. Shut it down now, we'll bring it back later. But we got the learnings into place once we started our corporate partnerships. We needed to be present within the corporate. But the learnings from the retail business helped us scale our corporate tie-up business very well.
Akshay, the question is, do we expect any new regulations that can disrupt lending?
Oh yeah, lots more happening, right? See, I think the regulator has allowed guardrails to how build a business, right? He hasn't yet capped the interest rate. He hasn't capped the way you do your business. So I think the next thing which will happen is he will cap interest rates, right? So as he brings in fair market practices, you will find you need to be more ethical in the entire practice, right? The third part is he will control synthetic credit to become more asset heavy. So you can say FLDG will come in, but the classification of FLDG will be far more severe. Right now, I think at least the next 18 months, he'll give you freedom to go build, see how large can you build it again. But both the sides, we are already seeing questions coming in on how to manage. Another area where we are seeing mostly the work happening, not from directly regulator, but from the government itself, which is coming on compliances and customer data protection. And many of these will start impacting many line functions, data storage, saving, asking, and transparency issues coming in. So they will in a way then go and result into business operations.
Thank you so much, Akshay. I'm sensitive to the time, and I know you have a 5 p.m. So thanks a lot for being here, for spending an hour with us. This was very, very helpful in terms of learning more about Fibe as well as addressing multifarious queries over here.
Thanks. Please take care, everyone. Thank you. Take care.